Okay, but we have a very special guest in the house. As you can see in the big frame, we have Mr. Raamdeo Agrawal right here with us. Needs no introduction, sir. It's been great that you could take time out to be here in our studios on our 9th anniversary.
It's always a pleasure to be here, and more on a special day.
Yeah.
So congratulations.
You've been part of this 9-year journey.
Yes, yes. We have been coming right from day one.
Yeah, absolutely.
And you have been coming to Omaha, and so probably
that's been for 2 years only.
2 years only, yeah.
But
many more to come.
Many more to come.
Okay, so today Raamdeo Agrawal is not going to chat daily markets. Today we've got him really as a market master. He's going to tell us how is it that you need to pick out stocks. What's the kind of homework, what's the kind of groundwork that you need to do before you choose and pick, given how stock selective or how stock specific this market is turning out to be. Just about everyone. We had Manish Chokhani as well earlier on the show, and he said that this is going to be a very individual stock specific market. Gone is 2017. Just forget about those days. That time is not really coming back anytime soon. So Raamdeo, let me quickly begin with this very interesting quote that you've culled out from Phil Fisher, which says that it seems logical that even before thinking of buying any common stock, the first step is to see how money has been most successfully made in the past.
Yes.
Is it imperative to say that the stock has to have given you those 20-30% returns in the past?
The quote is much more broader. And what happens is, in every country, every market, a set of companies do well, a set of businesses do well. Not that in every country, every business does well. Say,
absolutely.
Like our two-wheeler companies in India, they are bluest of blue chips. You have 3-4 of them, and all of them are thriving and making money. There is no other country. I mean, like say China, they are much. I mean, almost as big or bigger in two-wheelers, but there is no known two-wheeler company making money. Yeah. They make a lot of two-wheelers, but they don't make a lot of money. So even the banks, I mean, private sector banks, the way it is making money in India, there are very few countries where private sector banks that make that much money. They make money, but not that much money. So you have to understand in which country, which business is doing well, and once you know that these businesses are doing well, then you go to find the companies which are likely to do well. Because if you say we go from India and go to Japan, the companies in Japan are not the kind of companies in India. In fact, I was there in Japan 3 months back. I mean, the businesses are very different. They are more electronic components, global market share. Everywhere they talk about.
They're way ahead.
Way, I mean, not ahead or anything.
In terms of technology.
Yeah. So their whole focus is very different. Competitive advantages are very different. Their competitive advantages are global in character because it's a very small country relatively, but they have global ambitions. So most of the companies are globally competitive. So that's a very different dialogue when you go to the management room than what you do it in India.
Yeah. So let's drill it down to how you are looking at hunting for quality in this market, Mr. Agrawal. You're talking about indicators to classify a stock. I think at the very core, that's the problem that people have. There's such a big universe of stocks. What are the indicators that kind of drill it down to specific names that one would be interested in investing?
Yeah. So that's a process of, see, one is that. If you just want on a face of it, what is the current profitability? I mean, the quote of great, good, gruesome in 2007, page 6 and 7 of Buffett letter, that is very kind of very illustrative of how to look at the companies. So the companies or business will keep moving from one to other. Yeah. So right now I am referring to companies. So there are 3 types of companies. See, every country, every market, and now you can look at global markets. So now if we look at only India, where 4,000 companies are listed, there are 3 types of companies: great, good, gruesome. Yeah. These are like 3 bank accounts. See, look at Buffett started investing in 41. After 60 years, he realized that there are 3 types of businesses only. Yeah. So he wrote it in 2007. So what is a great business? What is a good business? First thing is, good business is something where cost of money is say 10% in India, 8-9%, 10%. Something which earns about 19-20%, say 20%. All the banks, good banks like HDFC Bank and all these banks, they earn about 19-20%. Now say, so on 100 crores, they make 20 crores profit every year. You input 100 crores at the beginning of the year, output you get is 120. Then what is so if you want to double the money, if you want to double the profit, 20 to 40, you have to put another 100. Okay, so after three or 4 years, once say 3.5 years, if you don't pay out dividend, say keep the dividend out, all the money which you earn has to be redeployed to double the profit in 3 years time. So 20% return on equity, 20% you put in the bank, it will again earn 20% more, and hence year after year keep compounding,
cycle,
and in 3.5, 4 years it will double the profit. But at that point of time, your money deployed will be about 200 rupees, and on that he will earn 40 rupees. Again your ratio remains same 20%. That's a good business. This is what typical good capital intensive businesses like banks and all, they keep doing. Now what is great? Great is what you start with, say 20% first year, second year you do 25%, then 30%, then 40%, then 50, 60, 100, and then you don't need any capital to make money. It's like getting cane juice without putting cane. Okay, so there are very few of them, like say
in the Indian context?
Yeah, in Asian Paints, Nestle, Lever, Indigo, I mean so far, unless they change the business model. And all these global companies, FANG companies, your Google, Microsoft, they all make money without putting any money, you know. So that is a great company. But these two, I mean like 1 or 2% would be great companies. Like in India, if you have 50 companies, I think I am exaggerating, maybe 50, 60 companies which are great companies. About, I would think 300 to 400 companies would be good companies. Then you have a long list of gruesome companies. So actually important is not to understand good and great. Say good and great, you can say good. One, what are the bad companies? See, because stock market is about, time is a friend of good companies and equally big enemy of bad companies. Okay, so this is the difference between gold and or real estate and stocks. So time is friend. So time is friend to good companies. So it is very necessary, if you want to become rich through the stock market in the long run, you have to fundamentally buy good companies.
So in this market, Mr. Agrawal, where you're seeing such a polarized market, 15, 20 stocks looking good.
I said don't jump,
No,
don't jump.
okay.
Let's finish this gruesome.
Sure.
Because that is the most important part
No,
of the
I
entire
was just
dialogue.
coming to gruesome.
Gruesome,
only, but
yeah.
go ahead.
So, because I read 45 times before I understood this. So gruesome companies are the companies which not only earn less than cost of capital, say 10% is cost of capital, you are earning, for some reason you are earning 4-5%, or you are actually making losses. Losses, no problem, because you realize that this is a danger zone. But if you are making 5% return on capital, so on 100 rupees you are making 5, now you want to double the profit. Every management comes and tells that useless company also, man, double the profit. Okay, now to double the profit, from 5 rupees you want to go to 10 rupees, how much money you have to put in? 100 rupees. Okay, and it will not earn that 100 rupees. It will take like ages, 15-20 saal lagega. So obviously what happens is you go and borrow that money from the banks and put in that user's business. So eventually what happens is, if there is any tough time, and typically this low return companies, they always meet with the bad times, more bad times than good times. Okay, now what happens is that it becomes a capital destruction all the way for the banks, for the entrepreneur, and of course the person who has invested. So year after year, and finally they actually, before, see, nothing goes to zero straight. So first they will go from say 20% to 10%, 10 to 5, and then negative.
My only question is, how easy is it to identify gruesome companies, Mr. Agrawal?
Very easy.
Would you have, I mean, in hindsight, everybody knows that JP Infra went bust, Arcom went bust, but at that time, was it easy to identify?
Or ICICI Bank, for instance, you know, which you would think about 2 years back is a great retail entity, but you never thought that these such issues will come up.
Yeah, so, you know, actually it's very easy. You see the 10 years return ratios, and most of the packages in the Bloomberg or Capital Line or somewhere, they give you summary of last 10 years, your EBITDA margin, PAT margin, asset turnover, and then finally they give you ROC and ROE. Okay, I wish I could show that. So whenever you look at the company, first you go to that ratio screen. At least I do that. You ask me some new company anywhere in the world, I'll go to that ratio, this thing, and then it's like a Janam Patri of any company. How it has been doing, how profitable it is, what is the capital efficiency, what is the, and the moment, you know, one of the things I use the terms of trade. So you have to use the ratios in combination. It's a kind of artwork in the sense that what ratio to be seen in particular company. So the moment company is profitable, it might be very temporary. It might be with lot of lot of compromises in the terms of trade, in the sense that
can
you
I
can
use an example here?
Yeah, so
Dish TV, a business.
I don't remember. It was not a great company till say a year back.
Yeah.
I don't know today what is the situation. Have they actually turned around? I mean, I hear
So
that
they did, but then they're again into losses. Now
Yeah.
there's of course Mr. Jhunjhunwala
Yeah.
coming. I'm just trying to, for the benefit of our viewers, understand. So, yes, return on equity and return on capital employed are very important ratios,
Yeah,
and you have to look at them in conjunction with the overall profitability of the business. But is there something that helps you?
Yes, so
like
the past
with an
and future,
example, if you
this could be
highlight?
two different things. See, past had been bad and patchy, you know that. Okay. Now, what is lying in future? There could be a change of the competitive structure. One of the thing is the change in the competitive structure. When say say telecom, telecom till 2003 it was in gutter, in the sense that nobody was making money. Then suddenly the regulation changed, and there was Bharti was available at $25. In 3 years' time, it went to 1200, and it became one of the most fantastic business. Then we saw the emergence of 16, 17 licenses, and the whole competitive structure got destroyed. And now from that 16, it has come to again 3. Now the repairing of competitive structure is done. Yet the competitive structure is very intense among these 3. So it will take some more time. But right now it is a bad business. Nobody is making money. All 3 are not making money. But it is creating a potential for a huge upside at some point of time, because everybody doesn't want to keep sinking lakhs of crores without looking for return. So someday return will come, but when, only time will tell.
You've got to be patient. So once you've identified the good, the great and the ugly, what about pricing? Because in this kind of a market scenario, the good and the great is coming at a very high price. It's only the rubbish which is available cheap.
Aisha,
Not all, but largely. How important is pricing according to you?
It is very important. See, no investing unless you buy at reasonable price.
Yeah.
Margin of safety has to be there. Maybe it is, at times it is 50%, at times it is 33%, at times it is even 80-90%, And there are companies even now which are 70-80% kind of margin of safety in my mind. See, margin of safety is in the mind of investor. You may disagree, I may agree. So that's where you will sell, I'll buy. Okay. So so in our QGLP formula, one is the quality of business. Once quality of business is done, you have to go one by one. So quality of business is done. And you have to go in the same sequence. If quality of business is not good, you have no business to look at the other 4 buckets of quality of management, growth, longevity of growth and price.
Okay.
All have to be clear, but I can do it in like simultaneously. All 5 I can do simultaneously, but the process is look at the quality of business. If quality of business is good, look at quality of management, which is most dicey in India, I can tell you. Most dicey. Because in management, because it's a piece of art. Every company is piece of art. If that guy is not wanting to make a nice, clean company in the future, I mean, you will not get a nice, clean company in the future. And sitting as a minority shareholder, what can you do?
Sir, I want to put in examples over here. How do you look at the ICICI Bank story? Simply put, it's a
You are
great
saying you're not putting example, and you asking me direct question.
No. I'm not. Okay, so don't tell me what you think about the business. But since you brought up the thing about management, right? Now, the lack of trust that the business has right now is only because it's going through a leadership transition. Nobody had seen it coming because it's such a big franchise. Just taken as an example, and ICICI Bank is not the only one. Axis Bank has also faced that. PSU banks have faced that. So how would you classify these businesses? Because banking per se is a profitable business in India, but they've just not managed the lending culture well.
Yeah. So if you see, I'm reading a book by Taleb, Skin in the Game. That book is worth reading, particularly in this context of Indian banking. And Mr. Kotak gave interview yesterday or day before, I think. It was a wonderful interview, and there he talked about skin in the game of the bankers. When you are giving 5,000 crores, 10,000 crores, do you really feel that you are giving 10,000 crores to somebody? How much pain you feel about giving, and how much due diligence you will do? Apart from the process, I mean, you complete all the kind of, this consultant has submitted, that consultant has submitted, that cash flow is submitted.
All the paperwork.
But yet, do you feel that money you are giving? So when you have skin in the game, you will feel that. So how do you bring skin in the game in Indian banking? Because the other side, the borrower has skin in the game. See, unlike in European and American country, this thing, corporations are also run by board, and the lenders are also the board driven. So both sides are kind of taiwalas. But in India, the borrowers are entrepreneurs, and the lenders are Taiwalas. So this having no skin. So one set of bankers have skin in the game, other set of bankers don't have skin in the game. So how do you bring a level playing field wherein the risk assessment or risk measurement is taken with a proper care? Lending is a very simple business at one level, but yet very complicated if you don't price the risk well. If you price the risk well and you lend somebody some crook at 30–40%, I think you'll make tons of money.
Mr. Agrawal, we'll take a very short break, sir, but we'll carry on this conversation. We'll in fact summarize the gist of this conversation for the benefit of our viewers with some examples as always of this very short break. Stay tuned. Welcome back. We are still in conversation with Mr. Raamdeo Agrawal, and for all our viewers tuning in, these are invaluable, priceless lessons in value investing that you're hearing from Mr. Agrawal's experience himself. Mr. Agrawal, let's talk about the possibility of a gruesome company becoming good and then a good company becoming great. You know, to your mind, which company has actually done that journey and has come on tops? We were discussing Bajaj Finance. Was ever a gruesome
all
company?
All the turnaround. See, a lot of these turnarounds, you know, I mean.
It was a good company that's gone great.
Yeah, so there are tons of it. If you keep doing this thing, I mean, say company like, say Bajaj Finance, we're just discussing that. So, I think 8–10 years back, it was a very ordinary, nondescript NBFC trying to do financing for the two-wheelers as a sister concern of Bajaj and all. And then everything changed. I mean, Sanjeev Bajaj took over as his main vehicle, and then the new management team came, Rajiv Jain and all. And first 2–3 years, at least persons like us who are watching from outside, we didn't realize what's happening, and it was already 10x. And then at some point of time, we realized that these guys are winning and they're doing something very extraordinary things in the same space. You know, they've found a completely new strategy and new target and new way of doing things, using computers, using the AI and all sorts of big data in a much more effective way to give loans in few seconds or few minutes to the customers, and that they opened a completely new segment on the customer loans and all. So it gave a completely new life to that company, and you see what has happened to the company from less than 1,000 crores market cap to more than 1 lakh crore market cap. It's 100x in just about 5–7 years. So it was I mean, it's one of the most wonderful stories. In fact, other banks, other NBFC, they are trying to do Bajaj Finance in their own banks or wherever. So there is admiration for this company. So from a completely gruesome or nondescript business or company, it has become one of the awesome, you know, example for the entire finance sector.
Absolutely. Any gruesome story though? Calling Bajaj Finance gruesome would not be really right. It was just a little indifferent, another company, insipid existing. Any gruesome company where you feel the story could turn around, maybe with the change of management? Yeah.
How do I know?
Right now.
How do I know? I would not know.
Nothing on your radar.
No. We would not know. We look back, and then we see some signs of it. Say one of the signs is that every quarterly, what happens is that suddenly you'll realize that whenever a company turns around, the quarterly results will show some 70–80% growth. Top line 15% growth, and then 80% profit growth. Okay, first quarter.
Very important.
Then second quarter, then third quarter, then yearly, first year. Okay, from 50 crores it goes to 100 crores. Something is happening. Then then second year again from 100 to 300 crores. Wow, these guys are now rocketing. You know, and then by that time market doesn't bother about it. Some insiders, close guys, they would buy it. The smart guys from Pune or smart guys from Hyderabad, they will buy. Or you know, people close to it. Market caps will be 1,000 crores, 2,000, 3,000 crores. Still nobody in the what you call institutional setup
would have a
you'll be scared and things like that. And then
no, they'd be scared. That's the point. They'd be like, okay, there's something, you know,
something is happening. But firstly, it should come in radar. Right now, the condition of the market is most of these rockets are already taken care of. I mean, the close guys, the mid cap, small cap, PMS guys, and the value pickers, I think they have picked up most of them. So 5–6 years back, that was the fun. You run a screener, you'll find 1 or 2 ideas, and then do masti. So that fun is lost right now.
Mr. Agrawal, we're completely running out of time, sir. But I need to get. So you know, I can think of 2 examples where the management really helped in this transition from gruesome to good to great. Actually, not even gruesome, but you know, just good to great was Aisha Motors and IndusInd Bank. Again, Mr. So Mr. Sopti
came, he changed the
and
complete
Eicher
profile,
Motors
yes.
again,
Yeah,
under
against
Mr.
Siddharth
Lal.
Lal, yeah.
So that's an example of
Yes.
good management
So
changing the business.
one of the ways a very ordinary or written off or nondescript business becomes great businesses or great companies is when the great management or right time comes for the management happens. So I think IndusInd Bank is a absolute classic case. I mean, it was a like 10, 12, I think 18, 20 rupees used to be the stock price, which is now 100 times or 250
it's an
times
index
more.
company now.
Yeah, index company, and it is one of the most foremost, though it was one of the oldest private sector licensee, but had not made any headway. And today it is one of the most aspirational private sector bank. So, I mean, in India, this kind of stories are too many. Lots of them. That's why India produces the highest number of multi-baggers. In major markets, the number of multi-baggers are produced in India is not common in other parts of the world.
Yeah. And that explains the India growth story. Mr. Raamdeo Agrawal, thank you so much for joining in today at our special day and giving us this valuable masterclass, which we don't usually get to chat about. Good to have you on the show. And we've completely run out of time on this edition of The Market as well. It's a goodbye and thank you for watching us for not just daily, but all of these 9 years gone by. It's a goodbye then from Tanveer and me as well.
Thanks very much for watching.